And you have been incredibly successful. What drives you?
I think one of my biggest drivers from the time I was a kid was independence. As much as I love my parents, I did not want to be reliant upon them. So everything from financial independence to the independence to say what I think, the independence to live the life I wanted to live. And so that's been a huge driver.
You've come back from failure, or at least the brink of disaster, twice in your career. You've had to shut down your first fund, and after Valiant, you lost a lot of assets. But it doesn't seem to faze you at all. How does this affect you personally?
So I've always had this view that success is not a straight line up. And, if you read the stories of successful people, almost every successful person has had to deal with, some degree of hardship, whether that hardship is, personal hardship, health related hardship, or a business issue. And I've always had the view that how successful you are is really a function of how you deal with failure. And if you deal with failure well and you persist, you have a high probability of being successful. So I've always kind of had that view. And then I've had to apply it to myself, certainly a few times. And I always like to say that experience is making mistakes and learning from them. And I've had the benefit of having made a lot of mistakes.
What are some of the lessons that you've drawn from those experiences?
It's interesting. In my first fund, I had a partner who remains a very good friend. And the stress of the ending was enough for him that he just didn't want to continue and do it again, where I was excited to kind of rebuild and go forward. And my business plan was just to make a little progress every day. And if you make a little progress every day, eventually that compounded progress will dig you out of the hole. And what is difficult is you find yourself in a hole, whether it's an investment hole or in your personal life or otherwise. It seems incredibly daunting to get back to, if you will, where you were. And you're looking up at this peak where you were before, and it's just, you're never going to get there. But if you don't focus on the peak and you just focus on, one step at a time, making progress, eventually, as the weeks go by, just make a series of smart, thoughtful decisions, use good judgment, stay healthy. Eventually you climb your way out of the hole.
I'm curious as to, you mentioned reading sort of a lot at night. I'm curious as to what your information intake looks like. Like, what publications do you read regularly? Books, blogs, specific authors, memos? What does that look like?
Sure. So, I read a lot of traditional media sources, Wall Street Journal, Financial Times, New York Times, Economist, Fortune, Forbes, Grant's Interest Rate Observer. And beginning sort of as I got deeper into coronavirus, I started using Twitter actually as a news feed and found it to be very, very helpful and interesting. Almost having the experience of reading the news a couple of days before you read the news and the rest of the media. Bloomberg News, of course. And then I just, I go where the facts sort of take me. And then, I don't regularly listen to, read blogs, although I'm starting to understand the benefits. So I'm a late but sort of recent adopter of finding more interesting curated news sources.
Is there information you avoid, like information that everybody else has?
Not really. I think it's helpful to have kind of the conventional perspective. And, I don't think we have, have some particular access to, some inside secretive news source that's valuable. There are people that I talk to for perspective on things like the economy and business, just people, business leader type people that I respect and compare notes with, what's really going on in China, that kind of thing. That can actually be quite helpful. But, I get a lot out of, reading the basic media, Financial Times, Economist, Atlantic, New Yorker.
How do you source your investment ideas? Like, where do the ideas come from? Like, how does that process work? Is it you? Is it your team of analysts? Is it?
Sure. So I would say the early days of Pershing, I would generate the ideas and the team would help me analyze them. And as the business has matured, and I really think it's a credit to the team and the maturity of the business, many ideas are sourced by members of the team. And my role over time has become one, setting the sort of the framework for things that are likely to be interesting, whether something fits within the framework or not. And then I'm usually the 20% person on every idea. So 80% of the work is work led by a 2-person subset of the investment team. And 20% of the work, the reading public filings, conference call transcripts, work that I do, the 80% work, a lot of that will involve conversations with experts to understand natures of businesses. And that's work that's largely done by other members of the team. And then the team overall discusses whether something merits inclusion in the portfolio. So some combination of a couple of people who worked very, very hard and devoted a lot of the last, perhaps a couple of months looking at an idea. One person, myself, that's spent not nearly as much time, but knows enough to be dangerous. And then, another, call it 4 members of the team that have not done real work on the idea, but are economically incentivized to make sure that, we make the right decision. And that's sort of the composition of how we get to an idea that makes sense traditionally.
Like, what does that process look like to build Ackman? How do you think about it? How do you walk through it?
So it starts with the framework of what we're looking for. So the most important thing for us is that the business quality is extremely high. And by business quality, I mean, we number one, we want it to be both a high quality business and one that we can predict with a very high degree of confidence. So it's got to be what we call a simple, predictable, free cash flow generative business. And the reason for that methodology is, the value of a financial asset is the present value of the cash that you can take out of it over its life. And particularly in a low interest rate environment, you need to be able to predict the cash flows for many, many years in order to figure out, approximately what the business is worth. And for many companies, we have no idea because the complexity of the business means we don't know what the cash flows will be 3 years out, let alone, years 4 through 50, which matter in terms of determining what the business is worth. So we look for sort of simplicity, and then durability and predictability. So it's got to fit that screen. And, we can talk about Starbucks, for example. So we made an investment in Starbucks a couple of years ago, not quite a couple of years ago. And what we saw was a simple, predictable free cash flow generative business that we could understand. And so it met the first screen. You think about coffee, people have their coffee habit. Starbucks has built in our view, a very durable franchise. They earn very high returns on, every store that they build. And it's a habit that people don't like to break. And so we had confidence in the durability. And, the benefit of the restaurant business is once you understand the economics of one box, and then you have a company that's built, thousands of boxes over time, it becomes more predictable and easier to understand what that business will look like over a very long period of time. And so Starbucks met the business quality threshold. And then the next most relevant consideration is price. And price, what matters here is that there's a wide gap between price and value. And so once we understood the business and we could model the business, we could look at where it was trading and compare those two. And at the time of our investment, there was uncertainty because the recent same-store sales had kind of flattened. And this was a company that had delivered consistent sort of mid-single-digit same-store sales over a very long period of time. And our analysis, the kind of crux of the analysis was, is this a blip? Is this an indication of things about to go awry? And that's really where we spent our time.
So you're looking at Starbucks, but there's millions of people looking at Starbucks. Where does that edge come from?
I think a big part of the edge comes from, we're not going to do a better job predicting next quarter's earnings than people who focus on that. And we just don't focus on that at all. What we focus on is, what is this business worth over its life? And do the markets generally overreact to short-term information and noise, because many stocks are traded on the basis of, the marginal buyer and seller is a short-term investor trying to predict whether the stock's going to go up or down on the quarter. And we you don't spend any time trying to figure that out. And that kind of activity, whether it's driven by quantitative traders or computers or fast money, so to speak, moves securities around occasionally to crazy prices. And Starbucks was trading as if the business had fundamentally changed. And our view is it hadn't, and that the company was taking all the right steps to address, some of the performance-related issues that they had both in the U.S. and that they had, a lot of opportunity for growth, and they were becoming a more focused, better company. So they were actually taking, normally we look for a great business that had lost its way. We try to figure out what they had done wrong, and then we'd recommend a series of changes after buying a stake in the company. That's sort of our core business. But in the case of Starbucks, they were already doing all of the things that we would have recommended that they do to fix the problem. And so it was a bit of an activist investment where the management had already become activists in their own company. And so we thought, I think a big part of our advantage is we didn't have to think about next quarter's earnings. Big part of our competitive advantage today comes from the fact that our capital structure compared to a typical investment firm is very different. 85% of our capital is comes from a public company. And as a result, we have very, very long duration money, and we don't need to worry about this quarter or this year in making decisions. And that, I think, is a huge advantage. In a world in which most other investors they give their investors either daily or monthly or quarterly liquidity, having permanency to a very large percentage of our capital base allows us to make very long-term decisions, and that time arbitrage is a big part of our advantage.